Hello everybody, my name is Drew Demon and I'm the Devil's Stockbroker. Well, we've been waiting for a long time for this, and now finally the official report from the Financial Services Committee of the House for the GameStop and Memestock squeeze event has been released. And now I'm going to walk through it with you guys for the next however long this video is to unpack it with you and make sure that we all understand very clearly what the implications of this document are. I have gone and skimmed through the entire document so far. I've highlighted a lot of the areas where I think that important information is being relayed and what the committee's findings were and what some of their recommendations and, quote, solutions are for what we're going to do about the markets and everything that occurred during the January squeeze. So, without further ado, let's get started. So, I want to highlight the two specific representatives that had the most to do with this particular paper and the investigations. One is Maxine Waters, a representative of California, and Al Green, a Republican representative from Georgia. Hey guys, future TD coming back here for a quick correction. So I made an embarrassing mistake. I mistook Al Green for Representative David Scott, who is the Democrat of Georgia. And I don't know how I got them mixed up, but David Scott was the one who was quoted for all of those statements that were made saying that retail needed to be punished or watched. So my sincerest apologies for Representative Al Green for misrepresenting him and for what I say in the rest of the video. But hopefully that you'll excuse the error. Now, y'all may not recognize these names, but Maxine Waters was the one who was in charge of the actual committee meeting, and she actually delegated and ran the entire event, as well as proctored the engagement between all of the House members. We're going to go ahead and go into this and start picking apart the findings. So a brief scroll through the table of contents. I took notice that the very first finding was that Robinhood exhibited troubling business practices, inadequate risk management, and a culture that prioritized growth above stability. It feels to me that this report is intentionally drafted to throw Robinhood under the bus. And while I do blame them significantly for the actions that they took that led to the buy button being taken away, they were not the worst of the brokers that did this. And I actually think that Robinhood is being thrown under the bus because there are other firms involved in this report even that whose names only show up a few times but were guiltier in how they responded to the events and actually voluntarily chose to take the buy button away despite not being nearly as at risk as Robinhood was. I still feel that this was a coordinated action and Robinhood is simply being thrown under the bus because they're the smallest and the easiest target. The second finding states that broker-dealers facing the greatest operational and liquidity concerns took the most expansive trading restrictions, although multiple broker-dealers introduced trading restrictions for a variety of risk management reasons. We're going to get into this, but this is exactly what I mean when I say that Robinhood's name shows up in this report repeatedly, but other brokers who took the same steps and actions even when it was not necessary for them to do so don't show up hardly at all. And I feel that these brokers may be even more responsible, especially as we connect events related to the GameStop squeeze in January and later events that took place during this committee's investigation. Thirdly, most of the firms that the committee spoke to do not have any explicit plans to change their policies for how they will meet their collateral requirements during extreme market volatility. Essentially, this translates to we realize that we got our asses handed to us by retail market participation, but we don't have any plans to fix it to prevent this from changing. And I feel like this is an extremely dangerous finding because as we pick it apart, we'll come to find that the firms that made their decision to take away the buy button have no plans to deviate from those actions if this type of thing were to happen again, and I have no doubt that it will. Fourthly, the Depository Trust and Clearing Corporation, hereafter I'll refer to as the DTCC, waived $9.7 billion of collateral deposit requirements on January 28th. This is essentially saying that they waived $9.7 billion worth of margin calls. Those capital requirements are necessary in order to protect the clearinghouse from broker risk. If the brokers become over leveraged, the DTC has the discretion to waive the fees for those firms to deposit additional liquidity to the clearing corporation if they choose not to force them to. And this gives greater liquidity to the brokers, but it also increases their risk, and it causes the brokers to be at greater risk of going into defaults because they don't have proof of their liquidity. So in the executive summary of this whole document, they highlight the main bulk of what's actually been decided and found as a result of this investigation. They kind of pay lip service to some of the really at-risk things that happened to the markets during this entire squeeze. But the big thing that I took away from this was that they are essentially putting all of the blame on Robinhood for their decision to take away the buy button, and they're only paying lip service to the fact that the whole reason why Robinhood was so at risk in the first place was because there was very little action taken by the clearinghouses to actually confirm Robinhood's liquidity and also to ensure that other brokers were taking the same steps during high volatility periods in the market. What I found so telling about this is that in the actual executive summary, they mentioned right here that other brokers suffered outages in their technology systems due to order volume in their trading systems. This is a common classic excuse for whenever you've made a decision to essentially remove people's ability to move money within your systems, you claim an outage. And brokers have done this repeatedly in history. Think back to the Big Short during Michael Burry's call, Dr. Michael Burry's calls to Goldman Sachs and other firms. All of them cited some kind of server issue, outage, or power outage, or any number of excuses because these firms, if they experience an outage, it's simply just bad luck, and they're not liable for that because they have no uptime requirements, and they're usually up 99.9% of the time. The fact that these coincidences all circulate around high volatility when these brokers are most at risk and they all had the same issues is not an excuse, and it is not a coincidence. I don't believe that for a second. And there's plenty of other events surrounding this investigation that bring us back to the fact that there are no coincidences in this market. The other part of this that actually really grinds my gears is the fact that they cite right here is that the total dollar amount of the AMC held by Robinhood customers decreased from 1.3 billion to 411 billion in the same time frame. This is directly as a result of taking away the buy button and limiting trading on these stocks, as well as simultaneously removing liquidity from the exchanges. And further down in this report, they actually noted that Robinhood during this entire period was never connected to the fucking exchanges. They were never connected to the New York Stock Exchange or the NASDAQ. So AMC was never being sent to the lit exchange at all. Robinhood was going explicitly and exclusively through all of their market makers, more than 90% of them, Citadel. You want to talk about a conflict of interest? There's the biggest example of it, is the fact that Robinhood was sending all of its orders, all of its trading through to the market makers, all of it was going to Citadel, and also to the Apex Clearing, by the way. But that aside, all of the risk that was being handled by the broker was being passed off to the market maker because they were forced to fill the orders for which they did not have the liquidity or even the shares in existence to do so. And they knew it. If this committee's findings don't show a direct link between Robinhood and Citadel towards the decision to take away the buy button, or the fact that just the liquidity requirements not being met was the sole reason for that, they didn't do nearly enough footwork. The one redeeming thing about this report is that they did actually uncover the inefficiencies and the total lack of oversight between FINRA and the SEC, and the fact that they have no real enforcement mechanisms to make sure that when they're putting these brokers on watch, they don't have any way of following up with them. And for that matter, the NSCC, which is the subsidiary of the DTCC, has no mechanism to notify or let these other brokers know that they're under additional scrutiny. So let's unpack this a little bit further before I get too ahead of myself. So Robinhood pioneered a new business model marked by commission-free trading supported by payment for order flow, in which trading platforms route their customer orders to market-making firms like Citadel Securities for a fee. In this business model, brokers can profit from volatility in the stock market as increased trading activity generates more payment for order flow rebates, and accordingly, Robinhood and other retail-oriented brokers are incentivized to push their customers to make as many trades as possible. This is a highlight of this report that recurs in here multiple times, and one of the fears that I have is that Congress is going to take action in order to target retail for making these, quote, gamified stock trading decisions. They make this statement repeatedly in this report that gamification, air quotes, is the greatest risk to the stock market. And I'm really concerned that this is going to lead to a big blackout of social media surrounding investment decisions and trading discussion. I would actually argue that gamification is honestly it's secondary to the actual problems of the massive market inefficiencies that are going on here. Because for one, Robinhood's app, functionally speaking, is extremely efficient, and it's actually really good in that it's able to allow you to get your information quickly and make a trading decision quickly, but it doesn't give you as much access to the data that things like Bloomberg Terminal are, which is extremely overwhelming for new traders. But that's not necessarily such a bad thing. What I want to see more from these long-standing brokerages is that they need a greater user experience to make their trading system easier and more approachable. The problem with our markets is not retail participation as a result of gamification. If anything, our markets are more toxic because it's gatekept by all these elites that are trying to keep it closed off from the general public and keep financial education from getting into the hands of blue collar workers. Because if we all understood how this worked, we'd all be able to make just as much money as they do. There's plenty of smart people in the middle class that would drastically benefit from greater access to the financial markets. And if we understood it broadly, then we would benefit too. The only reason why Wall Street doesn't want that to happen is because they make more money by trading on our behalf and giving us these, PP returns, like 5-6% returns off of trading where they're able to make 10-20% returns. And that doesn't even include their own standalone commissions, which are totally risk-free to them. It doesn't matter if they actually perform well, as long as they're meeting their fiduciary responsibility of actually generating some kind of return to you. They're getting their commission, but they're also making money on top of that through just the sheer performance that adds liquidity to their firm, which, of course, generates more money because they can take bigger, riskier bets. And that brings me to the next point of this, which is that the events of January 28th exposed massive inadequacies inadequacies in the risk management practices of broker-dealers. Specifically, concerns about the ways in which payment for order flow increases complexity and potential fragility of the securities markets, and the ability of regulators charged by Congress to oversee financial markets to assess and correct for liquidity and operational risks. We'll pick this apart a little bit later, but there's a direct link here that Congress has made between the fact that payment for order flow introduces, they don't explicitly state it, but it introduces a conflict of interest between the super brokers and their market makers and clearing firms, as well as it decreases their own liquidity because they're just constantly trying to take as much money as possible, shuffling it back and forth in the markets and increasing retail participation and basically trying to generate as much trading volume as possible. That makes their capital liquidity requirements so much bigger according to the guidelines by the NSCC and the DTCC. But if they waive those requirements, meaning that they're like, no, you don't have to post as much collateral, we'll just like waive that for you, then they're able to use that money in order to facilitate higher trading volume because they can provide that liquidity to their customers. And as long as they're encouraging their customers to trade more frequently, then it doesn't really matter to the broker because that's how they make their money. They don't want that money that would otherwise be used to enhance the trading experience for their customers to just be sitting in the clearinghouse waiting to be used for clearing trades and just as basically posted collateral. So here's the breakdown for the findings. Key finding number 1. Robinhood exhibited troubling business practices, inadequate risk management, and a culture that prioritizes growth and stability. They have a culture that prioritized growth above stability. So Robinhood disproportionately had high order flow and a unique formula for calculating their payment for order flow rebates, which strained their market makers and introduced additional risk. We can go into further detail a little bit later, but essentially by encouraging higher order flow, it's causing the market makers to have to shuffle money back and forth at a quicker pace. And I think that what actually happened is the market makers knew that they were trading with shares that didn't exist, and they had no way to actually borrow them because the stock had already been shorted more than 200% of the float that actually was supposed to exist anyway. The fact that GameStop's short interest exceeded its float so massively should have been a red flag to absolutely everybody in the market that there should be no reasonable way to provide this liquidity. And I love the Virtu CEO's statement about who's going to provide that liquidity, the liquidity fairy. Like that's the market maker to a T. They're just creating liquidity out of nowhere. They're creating shares out of nowhere. But the more they do that and the more directional the trades are, as in the case of GameStop, just everybody buying at once, it puts the market maker in a really dangerous position because they have to short the stock in response to those buy orders because that's how their models work. They take the other side of the trade. You buy a share, they short a share. That's how it works. And that's how they provide you that share. And if there's no way for them to cover the stock later on, then they have to go and buy it from somebody who's willing to sell in the open market. So there is no infinite liquidity pool. It's not real. So the second point was that Robinhood stated that it was, quote, always comfortable with its liquidity. Basically, whatever. Like, I really don't care how comfortable they were with the amount of money they had sitting aside for this risk. The third point is a little bit more important, that Robinhood relied on incomplete statistical models for calculating its collateral obligations. Basically, Robinhood drastically underestimated the amount of risk that they posed to the market because they were basing their collateral obligations, or the cash that they needed to have set aside, based off of quarterly highs and then doubling the number, not their all-time highs. And that is a FINRA guideline. So Robinhood just looked at the previous quarter's trading volume and said, okay, we'll just provide enough cash collateral to cover twice that much volume. And that wasn't nearly enough because the amount of collateral that they needed in order to cover the GameStop squeeze was more than it was almost 8 times what the actual squeeze caused. That was the amount of capital collateral that was necessary to facilitate all that trading that took place. And if Robinhood had established enough cash collateral set aside in order to meet their all-time highs for trading volume, then they would have never had such a bad liquidity crunch. So the other key findings, broker-dealers that faced the greatest operational and liquidity concerns took the most extensive trading restrictions. Big fucking surprise. Third, most of the firms don't have any explicit plans to change their policies for how they'll meet their collateral requirements during extreme volatility. And the DTCC waived their $9.7 billion of collateral deposit requirements, i.e. margin calls. And the broader implications conclusion surrounding all of this is that the stock market event, the GameStop squeeze, revealed how rapid growth and innovation in the retail trading presents novel issues for market stability and orderliness. This is a theme that I think that everybody should be aware of and pay close attention to, that they're placing a lot of blame on retail participation. They're very insistent that retail participation creates greater risk in the market. And this is a direct contradiction to statements made by Wall Street firms that they would encourage greater retail participation. In their mind, I'm sure that at the time they made those statements, they were positive that that would mean greater returns for them because they would have millions of more suckers to steal money from because they had greater access to the tools, the liquidity, and basically everything they needed to manipulate the markets in order to steal money from retail investors and leave us holding the bag. But now that the tables have been turned, this entire narrative has been spun in the total opposite direction, where they're blaming retail participation for creating more risk in the entire stock market. And I really worry about where this is going to lead us. There's a couple of statistics that were in here in the footnotes that I took some I did take some interest in. So apparently between January 1st of 2015 and March 31st of 2021, over half the customers who funded their Robinhood accounts said that it was their first ever broker-dealer account. That's actually encouraging to me because Robinhood had a good business model in that they created an app that was very easy and approachable for investors. I do think that it created some risk for us because it wasn't really a good app for giving yourself access to information, but it did increase our access to the market overall. And that was always good for us, but it created some risk. And it's worth noting that increased retail participation coincided with the bubble of the 1920s that led to the Great Depression, where a whole bunch of retail investors got involved in the stock market, and it resulted in a whole lot of people taking out loans, margin, and trading with margin money. And that created a massive liquidity crisis in 1929 when the stock market crashed. And that was unprecedented, and there was no event before that where we could have possibly seen this happening. But the fact that there is now more retail participation and that more than half of the customers that funded Robinhood said that it was their first account really is a highlight that retail participation in the markets is absolutely bigger than it's ever been. This is a testament to that. I thought it was also interesting that a FINRA report from February noted that new investors were younger, more racially diverse, and had lower incomes than the established stock market investors. That nearly 2/3 of the new investors were under 45 years old, and approximately 1/3 of this same group held an account balance of less than $500. That's astounding to me. That means that at least a 33% minority of the Robinhood funded accounts were trading with just whatever they had in their pockets. And this is who they stole from. Like, holy shit. What a revelation that most of us, well, not most, but many of us, at least 30% of us trading on Robinhood at the time that got robbed during the GameStop movement were trading with whatever we had in our pockets, less than $500. Jesus. All right. So here's a chart that shows the total open accounts for the selected clearing brokers. These were the main brokers that these are the main brokers that that the committee was looking at. We have Charles Schwab and TD Ameritrade, because remember, those two merged just before this happened. There was the Robinhood markets and E-Trade, which, if I'm not mistaken, is Morgan Stanley Bank. And then we also have the Apex Clearing Corp, which that's basically where all Webull trades get cleared through. So what we can see here in this chart is that Robinhood, from the fourth quarter of 2019 up through the COVID period, geez, it more than doubled. It went from 11 million all the way up to 22 million just in a single year. So Robinhood's customer basis doubled in a single year. And in the first quarter of 2021, wow, up through the first half of 2021, it went up by another, what is this? 70%? Yeah, it went from 22 million up to about 34 million customers in 2 quarters. Holy smokes. Dude, I can't believe that we're still funneling our money into these freaking people. I want to just kind of throw in a little bit of a side thought in here that I do think that Robinhood is being targeted and thrown under the bus here, not just because like they legitimately this was their fault. Like they screwed up big time. But this report really highlights how bad Robinhood was and focuses on them almost exclusively. What that says to me is that they really are trying to force everyone's attention onto Robinhood. I think that there are greater at-risk parties involved in this that we should really be paying attention to. Just saying, I don't think that Robinhood is the big problem here. All right. The reasons new investors cited for opening investor accounts was to save for retirement and the ability to invest with a small amount of money. It's unsurprising. Okay. So this information was compiled explicitly for the committee's investigation. It is non-public information. So what we're seeing here is not something that the brokerages usually track. I find that hard to believe. I think they have a very good idea of how many of their retail participants are trading with small amounts of money. I think that this plays directly into their revenue models. It has to. There's no way that they can't be aware of this. So Apex is significant here because they clear for hundreds of firms, primarily stock trading apps. I know this because Apex clears for multiple brokers. They clear for Webull for sure. They clear for Robinhood additionally. And I'm pretty sure that they also clear for IBKR, that's Interactive Brokers, and a couple of the smaller trading apps like TradeStation and Tradier, and like the little ones that probably most people haven't really heard of. So here's where we get into what I was saying earlier, that the surge in retail trading has provided retail investors with greater access to the market, but also carries risks. Specifically, they're pointing to the quote super broker business model that was pioneered by Robinhood. They're really throwing a great deal of focus into the gamification of investing. I really, I really think that this is Al Green talking here. Um, he's very much against, or at least he behaved in a way during the actual committee trials and investigation. The committee where you saw them talking to Al Tenev, or what's his Vlad Tenev, and Ken Griffin. That they this gamification makes it easier than ever to participate in the stock market for entertainment value akin to a high stakes multiplayer game. Like, this is Al Green's language all the way. I have no doubt that he had a hand if he didn't type this exact statement himself. He is so against social media and retail participation in the markets based on watching him during those committee meetings that I have little doubt that he, like, everything that he wants to happen as a result of this is going to involve an infringement upon freedom of speech when it comes to investing in the stock market and the ability to communicate about it on social media. There is going to be a targeted attack against YouTubers and social media influencers that focus on finance. Like, I have little doubt of this. I'm very concerned for the big ones like Matt Kors and Meet Kevin and Trey's Trades, and I'm sure I'm forgetting some bigger names out there. But this is something that I really worry about because financial education is what is most important here. This is what has truly introduced the risk to the market. And it's not a risk to the market, it's a risk to the incumbent kings and queens of the market. Because retail has become more educated and has been participating more in the market, we have the greatest chance to completely flip the income gap and the wealth gap. We have a chance to actually manufacture the greatest transfer of wealth in history, and they stopped it from happening. We're going to get to that later. I don't want to stay too ranty on this, but just because there's just so much to unpack here. So I found this particular statement by Bill Capuzzi. He's the CEO of Apex. He stated, "We've lowered the barriers to entry. There's great content. We're helping people invest in their future, and we see it. There's millions more people that are able to invest that never had a chance to before, and that's great. And that's going to continue and frankly accelerate, right? I think the impact of social media, is going to continue to evolve. And so, if the question is, do I think it's going to happen again? The answer is yes. For sure. No doubt about it. How it's going to manifest itself, I'm not sure, but for sure it's going to happen again. Now, I completely agree with this viewpoint that what happened because of GameStop is going to happen again, and it's still continuing to happen. Like, even as I'm writing or recording this, I can think of Weber and Revlon and Biora and BBIG and Mullen and all these other tickers that some of them I've called out, some of them have been called out by others, but all these major squeeze events that happened throughout 2021 and not so much 2022, but there's been a few. It's because we're able to communicate with each other and share information, and there's no need for people to be pumping stocks. Like, this is not even what's happening. We're just sharing information about what we see in the market. And counter to Al Green's idea that we're just gambling with our money, we're actually doing excellent research. And this is changing how the markets function because you have retail participants that are able to communicate instantaneously. And I don't understand how you could be against that except if you stand to lose millions and millions of dollars because your entire business model preys upon the stupidity of the average retail participant of the stock market. Limited access to information is one of the greatest tools of the elite to keep the average individuals, the crowd, the 99% under control. And that was true throughout the Middle Ages, the French Revolution, and many events in history where if you note in history every time that the public became educated, it led to a massive social uprising. Think of the Great Schism that started with a Frankian monk, Martin Luther, that just put a thesis, a printed thesis, because he had access to a printing press, the ability to put posters up on the wall of a church and say, these are the things that are wrong with the Catholic Church's ideas about Christianity. That's just one example. I'm not like picking on Christians or anything like that, but that ability to just to print papers, if that access to information had never been made available, then it's likely that Protestantism never would have existed. If we hadn't had the internet revolution, then hackers wouldn't exist. If we hadn't had the internet, then this Memestock revolution wouldn't have existed. Everything that's happening, every single social revolution that's ever happened in our history happened because the average person gained greater access and insight to the world around them. And the more we learn and the greater access to education, the quicker we realize how badly we're getting fucked by the system that we live in. So I'm going back here to this footnote because it mentions something that pissed me the hell off. Many modern stock trading platforms such as Robinhood, Webull, and other use app designs intended to increase consumer engagement, time spent on an investment platform, and number of trades through gamification. The amalgamation of these features has led to criticism that gamified online trading platforms promote user engagement by encouraging trading behavior similar to a gambling addiction. This pisses me off. It reduces retail participants to gambling addicts, which is that couldn't be farther from the truth. I'm sure that there's plenty of us that suffer from this, but it's not the majority. Okay, that's just factually inaccurate. There are more retail participants that are some of the most educated people that I have met that are collaborating and doing better research than even the incumbent trading firms on Wall Street have been able to do. And we don't even have access to nearly the number of tools or the liquidity that they do, where they can take this information, they can manipulate this information, they can send it out to the press and the journals like Wall Street Journal and Fortune magazine and whatever. They can push any narrative that they want people to hear. And they have access to all this, and we're still able to do better research than all of them put together. And that just the fact that half of what we see written in this report is already known by the majority of retail that have been involved in this community and in this movement for so long really is a testament to just how fucking good we are at doing our goddamn homework. So I refuse to allow this statement to reduce us to a bunch of gambling addicts, because even though that's like the theme of Wall Street bets, it's not the theme of the majority. And half of that is a fucking joke anyway. So they're just taking Wall Street bets culture and applying it to the entire retail trading mania. Like, that's it. They're just reducing us to maniacs and gambling addicts just because Wall Street bets is the board that led this thing to happen, because it was the vehicle for the information to be spread. But like, Jesus, Deep fucking Value was incredibly insightful and intelligent, and he was entrenched in the financial world. Like, that was his career. And he shared extremely good information with the public, which went viral and circulated so quickly because it was good. It wasn't because everybody's a gambling addict and took the same bet at the same time. Like, that's not how it happened. I gotta get off this rant and keep going. I will say that I am really frustrated that half of these links here are to New York Times and Wall Street Journal articles that are paywalled anyway. There's nothing more frustrating than being stymied by that goddamn paywall. So this was one of the findings that I do feel slightly encouraged by. Regulators must ensure that broker dealers properly assess and prepare for the full implications of such new innovations. The Memestock market event demonstrated the need for the modernization of our retail market regulatory architecture. I am concerned that they specifically mentioned the regulatory architecture as it results to retail market participants, but I do agree that it needs an overhaul. But this is a vague statement, and I'm worried about what they really mean. Like, I'm trying. There's a lot of ways you could interpret this. This could mean hurting retail participation, or it can mean overhauling the regulators so that they're actually doing their jobs. It could go both ways. They do clarify it a little bit here with corrections for capital and liquidity and operational risks associated with the rapid growth of retail trading. So, that much I do agree with, that we need to have greater transparency. For one, they didn't state that here, but there does need to be greater scrutiny over the capital and liquidity requirements of the brokers, the clearing firms, and the market makers, because they're the ones that are creating the real risk in this environment. If they're playing with cash that they don't have, that's where the real risk is. And the regulators aren't doing their jobs. We know this. The regulators are not efficient. They're even if they aren't even if they are totally innocent, like we'll just give them the benefit of the doubt for half a second. Even if the SEC is doing their absolute very best, they're still wholly so inefficient because they're just too few, and they have too their technology is so dated. They're not even connected into the exchanges and the dark pools and the other broker systems the same way that we are. They're so outdated in the way that in their capabilities to investigate and enforce that it's really like they're trying to fight crime with magnifying glasses and a feather duster, trying to lift prints. Like they're not like the forensic geniuses that you see on NCIS or whatever show you want to take away from this. Like the SEC is doing the same thing that they've been doing, the same way they've been doing it since the 1980s. They haven't kept up with the changes to technology. Like they haven't really had a fundamental overhaul of their investigation systems, at least not that I know of, since the stock market crash of 1987 when they introduced volatility halts because of the crash that occurred because of automated trading just causing a massive sell-off so quickly that humans couldn't react fast enough. So this is what they're referring to here when they say that the self-regulatory organizations or the SROs overseen by the SEC will need to be further evolved to fully address the risk generated by a new generation of retail-facing self-directed broker dealers. So they're calling any self-directed broker dealer a super broker here. So we have to pay attention to this term. I'll break it down here really quickly. Super broker is just any firm that is its own broker dealer. They have their own trading platform, they have their own clearinghouse, and they have their own routing system in order to allow retail participants to go and do all of their business through a single application. So that's what they're referring to here as a super broker. And the other part here that I noticed was that the DTC subsidiary, the National Securities Clearing Corporation, or NSCC, which sets and enforces rules for clearing equities, engaged in insufficient monitoring of its membership and has regularly waived certain clearing fund obligations prior to the market event. This is where there's a much bigger issue because the clearing firms aren't watching their brokers, and that's where the real risk is here. And I'm kind of upset that the investigation listed this as like the last issue to address when it really should be the first, in addition to all the regulatory scrutiny. But as they break it in, they go into it in a little bit more detail here. So FINRA has issued guidance on the topic, but their guidance is non-binding and does not require systemic liquidity reviews for broker dealers. Basically meaning that FINRA can make suggestions for how broker dealers address their liquidity and their capital requirements, but they're not They don't have any way to enforce them, and the broker doesn't have to listen, that's a problem. Like if your own regulator is only able to like issue advice and say like, you don't really have a good way of measuring how much cash you need in your bank account. Like you're kind of dealing with like $200 billion worth of at-risk assets, and you've only got 2 million sitting in the bank. That's kind of a problem. Like, like, come on, come on. And I know that that's a hyperbolic example, but that's essentially what we're dealing with. Is that FINRA just gets to make suggestions like, oh, you should probably have a bigger cash position, and the broker can be like, cool, we're not going to, but thanks for the advice. It's like it's stupid. It's just paying lip service. FINRA is totally useless. And the risk monitoring policies are totally inefficient too. The cycle examinations review capitalization and liquidity on a case by case basis, but are not mandatory. What's the point of FINRA? Like, what else are they here for? Like, what else are they here for? They just examine your liquidity, but any changes that need to be made are not mandatory. That's what the fuck is the point? What is the point of having this regulator that just says you should do this, not you must do this? Good God. So the report goes on to say that they don't have any foundation to police the liquidity of its member firms, and the NSCC has yet to modernize how it oversees its own firms. It doesn't have a way to maintain or assess credit risk posed by the members of the NSCC. The watch list and the enhanced surveillance list, which is basically saying at-risk participants. Any broker that's on these lists is basically like on the shit list of the NSCC. But the firms that are placed on the enhanced surveillance list are not notified. Like, how are you expecting the brokers to actually behave themselves if they don't even know that they're being watched? It's just paying lip service. The NSCC isn't actually forcing these brokers to maintain their capital requirements, and if they fail to meet their capital requirements, the NSCC is not telling them like, "Hey, you're misbehaving and we're watching you." They don't even tell them that. The lack of transparency misses an opportunity for the NSCC to communicate to relevant member firms the need to adopt remedial measures. Basically, the fancy talk for what I just said. The committee's investigation revealed how the NSCC has regularly waived clearing fund requirements in the last 2 years before the Memestock market event. Now, this is the part that really pisses me off and gets me scared. Because, so excess capital premium charges. This is when the NSCC tells the broker, hey, your portfolio is too risky and there's not enough cash set in your margin account to make sure that you can cover that risk. You need to make a deposit. So if they waive that, it means that they say your portfolio is extremely risky, but we'll give you a pass on it. Don't worry about it. And they're doing this all the time. They've been doing it regularly. This is dangerous for multiple reasons. For one, if the broker's got a risky portfolio and they don't have proof that they have the liquidity to manage that risk, then there is nothing to stop a broker from going into default. And you know what really pisses me off is that they know this, but they choose not to deal with that anyway, because the brokers can just continuously skirt around the rules until they come up with the money later on. And then they tell their customers, oh, we're just having some technical issues, or they'll cite some excuse for why they have an outage, or they'll turn off the fucking buy button, or they'll just delay deposits and withdrawals, or they'll eliminate withdrawals entirely and just freeze your money. Like, there's so many things that can go wrong here because the NSCC is not actually forcing the brokers to prove they have the cash. Fucking hell, I'm going to have an aneurysm. So the NSC's regular waiver most often benefits the member firms that regularly attract these charges. The apparent repeated failure of excess capital premium charges from deterring such firms from accumulating excessive risk is concerning. So the committee is at least on our side that the NSCC is waiving these capital requirements far too much. I have little doubt that they're going to continue to talk about it. What I doubt is that they'll actually do anything about it. Because throughout this report, they're citing that they're going to leave it up to FINRA and the SEC to do something about this, not that they're going to enforce the change themselves. The regulators are not doing their jobs. They are not acting as the watchdogs. While NSCC rules permit discretion in waiving or reducing excess capital premium charges, the rules contain only limited guidance detailing how or when it's appropriate to waive or modify these charges. This lack of detailed guidance undermines the predictability of NSCC decision-making during exigent market circumstances, such as during the Memestock market event, which in turn leads to confusion, uncertainty among NSCC firm members. So that's exactly what I'm talking about. If they do not have any rules established for when it's appropriate to waive or modify those charges, then they're just going to keep giving them passes. I have no doubt that there's some conflict of interest going on here. There is some communication going on between the NSCC and its member firms that they're allowing these passes to be made, because whatever risk a single broker takes, like Robinhood, is putting all the other participants in the NSCC at risk. Because if the NSCC gets into default, or if one of their broker firms goes into default, then the other members have to pick up the tab. That's how it works. So if one broker goes into default because they took on a really risky portfolio and then found that they were totally insolvent, then the other members have to pick up their tab. And that's the penalty, for not policing themselves. So these firms, these Wall Streeters, are at massive risk if just one of their members is misbehaving, and if the NSCC is not enforcing those changes and making sure that those firms are paying their capital premium charges, then they're putting the whole stock market's participant list at risk. I can't believe that this has been going on for so long. I'm really proud of the ape movement because we made this investigation happen, for one, but at the same time, I'm really scared by the implications of all this, because we found worse things than this. We found that they are misbehaving even more than this, and FINRA's not even applying the appropriate penalties and charges to the Wall Street firms that are misbehaving, let alone all of the ones that are at such risk of going insolvent. This is a serious problem, but I am at least very proud of the apes and all of the meme stock degenerates out there, whoever you are, whatever you want to refer to yourself as. I'm really proud of us and all of you that we unraveled this fucking thing, and we really forced Congress to look under the hood and understand just how screwed up our system is and how desperately it needs an overhaul. And even though some bad things may come out of this, these statements made here at least encourage me that they're looking now and they're paying attention and they are very worried about what they found. So there's a few things regarding how members are placed on the watch list and the enhanced surveillance list. It's based on their credit rating. So if their credit rating is bad, then they get placed on the watch list. And if they misbehave, or if there's some additional at-risk event that involves that firm, they get thrown onto the enhanced surveillance list, which they don't really have any way of communicating. They don't even bother telling the firm that they're being watched closer than anyone else, which I think is stupid, and apparently so does this investigative committee. But that's really concerning, because now that proves that that's been going on for a long time, and it's just been that way, that the NSCC just doesn't really. They may be paying attention, they may not be, but they're not going to tell the firms that, hey, you're being watched and you're misbehaving, and these are the problems that we see. You need to fix this. How are they going to know that they're even under that kind of scrutiny? If they knew they were being watched, they would probably be more inclined to participate in a fair and orderly manner and manage their risk better. if they don't know that they're being watched because they've been taking risky behavior, then they're going to continue to act in a risky manner. Like that, that's like holy shit. It's like okay, so the NSCC is your parent, right? And you're a shit little kid, okay? And your parents tell you like don't go play in traffic. Don't go play in traffic, okay? So the parents, they catch you playing in traffic 3 times and then they say don't do it again. And then that's it. And they just watch you from the porch while you go play in traffic again. And then they wait for you to come in, have dinner, and then they beat the living hell out of you for misbehaving for the 4th time. Like there's no like that's that is how this entire system works, is that all of the member firms of the NSCC need to be policing each other, because it is a communal policing effort. If they're not if they are not policing each other, if they're not watching each other, and they're not telling each other that they've got eyes on you, then they're going to continue to misbehave. And especially if they're not making regular reports of misbehavior and misconduct to the FINRA and SEC. So here's a little bit more detail on it. They interviewed multiple broker dealers and they revealed that there was considerable confusion, inconsistency, and a lack of awareness among retail-oriented broker dealers as to how the NSCC collateral requirements are calculated. Like, dear God, don't you think that would be something that would be helpful to know? Is if you're going to be required to post additional collateral, that the NSCC should tell you how they figure that number out. Like that must be such an awkward and uncomfortable conversation to have. It's like that you suddenly get told by the NSCC, like, hey, we think that you might be risky and we're going to ask you to post some collateral later on, okay? And they're like, okay, well, how do we figure out those numbers? They're like, I don't know, we'll get back to you on that. And then they just tell them, like, hey, you need to post $20 billion by the end of day, just randomly out of nowhere. Like, and these firms have to just figure it the hell out, like how they're going to come up with their. I think that they don't have a process. That's what I think. I think the NSCC doesn't actually have a process, and they make the number up out of thin air. It's the only way that this makes sense. Because if they actually had a method for doing it consistently, then they would probably have already told the brokers how. Because it's in their interest to do so. Well, I think that the NSCC is just functionally crippled. Good God. In addition to these findings, according to the NSCC, certain broker-dealers that are familiar with excess capital premium charges decided to remain thinly capitalized and consciously risk attracting these charges on a regular basis. So that's a telling statement. The NSCC knows the brokers that are the most likely to misbehave and the ones that are most likely not to post any additional liquidity until asked. And they're the ones that are going to operate with the greatest amount of risk and use their capital at their discretion rather than setting it aside for volatile market conditions. That's upsetting because like I said, the NSCC, they're functionally crippled. And given that the NSCC often waives these charges, these firms may feel that they are unlikely to be seriously penalized for such risky behavior. As I said, if you do not punish the misbehaving child for playing in traffic where that could get them killed, they're going to do it again until something bad happens. Either they get their whooping or they get hit by a car, okay? And that's the situation we're dealing with. All right? This is freaking mind-boggling that this is how things have been run by the clearing firms this whole time. The committee's investigation discovered evidence of multiple broker-dealers, third-party clearing operations, market makers, public stock exchanges, and others suffering technology outages during the Memestock market event. Excuse me, there's no way. There's no way. Every single one of these firms have data centers that are triple redundant and they exist in closed They exist in closed data centers that are strictly maintained by the highest order of uptime availability. I know this for a fact. There is no way that they would all simultaneously suffer an outage unless the entire internet blacked out and then so did everybody else. This doesn't happen to our stock market. This isn't a coincidence. It's fucking improbable. Unless the entire internet had an outage in the state of New York, they all had a reason to not be operating. And it was because they didn't have the collateral, it's because they didn't have the liquidity, and it's because they didn't want to pay retail their fucking checks. Because we won. And they had to figure out some way to delay and delay and delay and figure out a way how to get out of this fucking mess that they put themselves in. That's hilarious. This is fucking hilarious. So the outages are particularly concerning among market makers who are by accounts lightly regulated and play an increasingly significant role in executing retail trades. Everybody who's listening on this channel should know this, but market makers execute 90% of our trades. Market makers make up the exchanges are basically irrelevant now because the market makers provide all the liquidity to the market because they are the liquidity fairy. It's because they just make the shares up. All right. We know this, and you can look back on all of my previous videos on short exempts and how those tie into the market and how market makers just create shares out of thin air because they're enabled to. They're so lightly regulated that there's no insight or there's no way for the SEC to like even knock on all their doors at once to go and make sure that they're behaving correctly. And market makers have been caught multiple times, Citadel especially, by trading ahead of their customers and front running trades. And they know that this is going on, but they just choose not to enforce it regularly, or they don't have the capability. They just pay their speeding fines and go along the way. And it does sound like the committee is at least aware that this is now going on, or at least they have some inkling that shit's not quite functioning the way it's supposed to, and maybe it's not fair. But whether they actually do something about it is unclear to me because they seem to be leaning heavily on FINRA and SEC involvement here to make the changes. And I have no expectation that the funding for FINRA or the SEC are actually going to improve the situation. Or even if they would increase funding for these two firms. The regulators are just drastically underfunded. And the SEC is not capable of enforcing to the degree that it needs to. I do feel for Gary Gensler, at least to some degree, that I know that the SEC is underfunded, but I also feel like there's hardly any evidence that they're pushing for it. There's no evidence that I've seen publicly that they're pushing for the aid that they need to actually enforce these changes, and they seem pretty content to collect their fucking speeding fines from Citadel every time they front run a $2 billion trade and pay like a $200,000 fine. It's so stupid. This whole system is so fucking stupid. Oh my god. So on January there is currently no FINRA or SEC requirement for broker-dealers to be active members of a public exchange, and on January 28, 2021, Robinhood was not connected to the New York Stock Exchange, NASDAQ, or any other public exchange where it could have routed customer orders for execution. Instead, Robinhood was solely reliant on its market maker firms to execute trades, most of whom were struggling under significant operational stress in the face of historic volume and volatility. Guess who their favorite market maker is? It's fucking Citadel, followed very, very distantly by Virtu and then UBS. Citadel executes more than 80% of the trades for Robinhood. 10% of the trades and the remaining 20% are shared by Virtu and UBS, mainly Virtu. But Citadel is the vast, overwhelming majority. And they benefited from this, okay? Citadel made a fuck ton of money from all of that volatility. You know that they did, especially the fact that they were able to turn off the buy button and they were able to use short exempts to just drive that price down into the fucking ditch. I'm getting all pissed off. I swear I'm gonna have a heart attack just reading this thing. Pursuant to its oversight authority, the committee has provided a list of recommendations for possible regulatory reforms at the SEC, FINRA, and the DTCC to increase resiliency, transparency, oversight of, and access to the equity markets. These recommendations reflect recent developments in the stock market, including the influx of retail investors and the rise of prominent, quote, super brokers, unquote, with millions of retail customer accounts. These potential reforms include greater attention to the identification of potential problems that may be caused by technological or other changes to market entry that lead to broader participation by individual investors. I This is what I was worried about. This is what makes me nervous, is that they're really putting a heavy emphasis on the fact that broader retail participation is the problem, when we know that it's because the regulators are not policing the Wall Street firms. This is what I'm worried about. I'm worried that FINRA and the SEC are going to be charged with figuring out a way to control retail investors more so than controlling Wall Street. And if we're going to start seeing evidence of this, it's going to come in the form of charges against individual investors rather than the misbehavior of the retail or the real. God, I can't even speak anymore. It's going to come in the form of charges against retail investors rather than the misbehaving and misconducting Wall Street firms. So potential reforms also include alternatives to how the NSCC assesses and applies margin charges, enhanced risk management and liquidity management, and reporting requirements for clearing brokers and other similar measures. In summary, these recommendations include the following. Now, I've marked these out in red if I think it's something to be concerned about and it throws red flags for me. It's green if I think it's a good thing. So, first, Congress should adopt legislation mandating key regulators, including the SEC and FINRA, to study how existing market rules and supervision need to evolve to address new technological developments, including the possibility of social media driven market activity. This being the first note of recommendations is what scares the shit out of me. The first thing that I think that they're going to do is they're going to find a way to silence YouTubers and finance influencers, basically. People like myself, Matt Kors, me, Kevin, Graham. I can't remember his last name, but just anybody that's in the field of YouTube finance or any social media influencing regarding finance and investing are going to be under such tight scrutiny that we'll be able to hardly recommend a stock without having the SEC pound in our door and tell us to shut the hell up because we're pumping the stock or we're bashing a stock. Which, by the way, is fucking ludicrous because you have all of these fucking assholes coming out on CNBC and CNN and Fox Business that are all talking about the stocks they love, the stocks they hate, all they want to. They have full national news coverage of their fat ass faces talking about everything that people should be pumping their money into. You have asshats like Jim Cramer on fucking Mad Money. Go buy Netflix, literally. Like, just buy Netflix, nothing else. Buy Netflix. And then it tanks 3 days later and everybody loses every fucking penny. That shit shouldn't be under investigation. I'd rather see the newscasters investigated. So that's what I'm really worried about by this point, because the fact that they're focusing so much about the influx of retail traders, we've been here the whole time. We just have a method of communicating with each other so we can figure out what is actually a good stock and picking apart the information that's really meaningful, not just listening to whatever the mainstream media talking heads tell us to buy, which is stupid because they're wrong more than half the time. And there exists many conflicts of interest that I can think of, namely Jim Cramer. I'm going to keep picking on his fat ass because Jim Cramer has recommended so many bad picks with remarkably awful timing. And there are many incentives for somebody in a position like his to influence the markets. He was a former hedge fund manager who was quoted, he was quoted I'm sorry. He was quoted as saying that it doesn't take much money to move the futures market and put out a story to move it in the direction that you want. Like that was such a remarkable admission of stock market manipulation, unlike anything I have ever heard of. And it's hilarious that he did not go to jail for those statements. And now he's a newscaster on CNN recommending stocks. If anybody listens to Jim Cramer after those statements, they're a fucking idiot. I'm sorry. Like, Jim Cramer. I'm not gonna. You know what? Never mind. I'm not gonna make it about him. I just think he's. I think he's a fucking idiot, and he's at least either incompetent, he has the worst luck in the world, or he is pushing a narrative based on whatever he's told to say. And I think the latter is the one that scares the shit out of me the most. So the second point under the understanding the influx of retail traders is that the SEC should consider ways to implement trading halts tailored to respond to concentrated volatility in a number of stocks. This one should worry you. This means that the SEC should figure out a way to stop volatility on stocks based on retail participation. They want to stop stock movement and price action based on social media influence. You know what? This can be both a good thing and a bad thing, but I worry that this is going to be weaponized against retail traders because if we find a good stock that we know is an excellent pick, if we see value somewhere, it should be our right to invest accordingly. And volatility halts were always meant to protect us against algorithms. That is the purpose of volatility halts. They were introduced after 1987's market crash because automated trading systems sold shit so quickly that humans couldn't get on the phone fast enough to respond to it. And it caused the biggest market crash in a single day in history. That is why we have volatility halts. It's not to stop people from pumping and bashing stocks. That should be the SEC's job, to investigate pump and dumpers and charge them accordingly. I have no problem with that. What I do have a problem with is for them to selectively choose stocks that are being talked about on social media and halt them based on volatility that isn't actually there. If they choose to start locking up trading on stocks just because they become popular on social media, that is fucking dangerous because that allows it to be abused so easily. Every single Wall Street firm has a direct line to the SEC's desk. I guarantee it. They have somebody inside the SEC that they can talk to figure out some way to abuse this. I have absolutely no doubt. The SEC's been asleep at the wheel since 2005, at the very least, probably longer than that, because they found all of these SEC upper management watching porn during the whole market crash and bubble that took place from 2003 all the way up through 2009. The SEC is a joke. And if we really are so delusional as to believe that there are not members of the SEC acting as moles for the Wall Street firms, then we honestly we deserve to get bamboozled because everybody should at least be suspicious of members of the SEC acting in the interests of Wall Street firms. There are dirty cops everywhere, but wherever there is money involved, you will find them. And what better place than the cops that manage Wall Street? Just my 2 cents. So this is where most of the good stuff is. Enhancing supervision of retail-facing superbrokers. Congress should adopt legislation requiring broker-dealers that execute above a predetermined threshold of customer orders to establish and maintain a connection to a public market. Yes, this. Absolutely. That means trading on a public exchange. Lit exchanges only. Maybe not only. I'm sure that market makers will still be necessary going forward. But at the very least, broker-dealers need to be connected to a lit exchange and at least have the ability for retail participants to route their orders to a lit exchange. The fact that I only have one broker that I know of for a certainty, that is Fidelity, that will actually route my order to the exchange and provide me the ticker tape receipt to prove that it was executed on the exchange, is a testament to how fucked up the rest of the brokers are, because none of them do this. None of them connect to the public exchanges and allow retail traders to execute in the market of their choice. There's so few of them. TD Ameritrade and Fidelity are the only two that I know of for certain. Fidelity is the only one that I know of that will actually provide you evidence to prove it. That is important. We must have this. And I will reiterate for everybody else that if you're trading on any of these brokers, you need to be able to trade on the lit exchanges if you want your orders to matter worth a damn. If they're getting filled by a market maker, then you're losing money. The second point is that Congress should adopt legislation requiring broker-dealers that make markets and provide liquidity to other broker-dealers, which process above a predetermined threshold of order flow to be subject to regulation SCI. I am uncertain of what this regulation is. I haven't dug into that. I'm concerned about some of the things that I read in the highlights. I'll probably have to do some separate research into this and address it in Hell's Trading Floor, but we're going to dig into this later when I have more time. Third point, the SEC and FINRA should enhance large retail-facing broker-dealer examinations and mandate stress tests that focus on liquidity management. Yes, absolutely, including to account for the prospect of social media-driven market volatility. Again, concerning, because if they introduce volatility halts just because we talk about it on social media, that's fraud, all right? That's not right. So if they're going to increase their liquidity and risk management, fine. But if that risk management includes shutting off the actual transactions and turning off the faucet when you have a run on a stock, which is a natural occurrence that has happened many times in the markets, the only difference is now it's retail that's profiting off of it. That's selective, and it's class warfare. The SEC and FINRA should introduce a requirement for clearing brokers to establish written contingency plans to address extreme market volatility and fully disclose both the contingency plans and any trading restrictions to the market in real time. Yes, this is just like volatility halts on NASDAQ and NYSE. There is a public feed that the public can be aware of. Anytime there's a volatility halt, it's instantly posted to the tape. You know immediately. And that should be available the same way. And the SEC and FINRA should be immediately notified if any stock gets halted for trading at any point that has made a decision by the brokers. If the brokers decide to turn off the buy button, then the SEC and FINRA should get a big fucking red blob on their screen saying, hey, go and check these guys out and make sure that they're turning this off for legitimate reasons, not just because it's their own fucking pocketbooks that are at risk. That is the point of being a broker. You accept the risk of doing your job, which is to fulfill your customers' orders, regardless of risk to yourself. It is not fair to be able to selectively turn it off just because your portfolio is at risk. That's not how it works. You're in a position of tremendous authority and responsibility. Congress should adopt legislation that directs FINRA to conduct more thorough supervision of the broker-dealer industry, and the SEC should conduct more thorough oversight of FINRA's activities. Yes, 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 yes. FINRA has been a lame duck for decades. They've hardly ever issued any fines of any meaningful value, and the SEC should be able to take action against them too, because FINRA is the self-regulating watchdog of Wall Street. They are the worst example of a conflict of interest when it comes to a policing organization, because they themselves are the Wall Street entities. If FINRA is not acting in good faith for the good of the retail investor, it should be enforceable that the SEC can take action against them. When individual firms introduce trading restrictions, they should be required to notify the SEC and FINRA. Already stated this, but yes. Once introduced, FINRA should engage in enhanced monitoring to ensure that such trading restrictions are appropriate, tailored, and in place no longer than necessary. Yes. Fucking thank you. Strengthening capital and liquidity requirements and oversight. Number 1. SEC should introduce capitalization requirements for clearing brokers. Yes, the SEC has not been doing a good job of keeping up with this. And for that matter, something that isn't in this is they should be increasing the fines for misbehavior and misconduct. But Lord knows if we'll ever see that. The SEC should introduce a liquidity rule for clearing brokers. FINRA should establish a rules-based framework for governing liquidity planning and for clearing brokers. Yes, the DTCC and its subsidiary, the NSCC, should revisit how it conducts surveillance of member firms that may pose greater risk, and FINRA should also focus on systematically assessing the sufficiency of clearing brokers' liquidity planning. This is overall good for the efficiency of the market and also the risk management of the market, because right now there's no oversight as to when brokers are over leveraging themselves and are not posting sufficient liquidity. This is the problem that allows naked shorting to take place without any repercussions, because nobody's looking at their books. Nobody's paying attention to the behavior that is considered risky. If they're writing a whole bunch of loans out for shares that don't exist, that's a problem because the broker is the one that's actually on the hook for that. And if they're lending out all these fucking shares that don't exist to these other hedge funds that aren't aware, then they're indirectly creating risk in the market because those hedge funds have no idea that they're borrowing shares that don't exist. If they knew that, in the words of Mark Cahodes, he never would have gone short on overstock.com. Just as a clear example, because in 2005, overstock.com was the most heavily shorted stock at the time before there were even any disclosures around the amount of shorting that took place. And it was only after a retroactive investigation that they found that Overstock was shorted more than 100% of its total outstanding stock, meaning there were more shares in the market than should have existed. No action was taken against them, and it was only because they figured it out after they investigated Goldman Sachs. They had to investigate the biggest prime broker on Wall Street, or one of the biggest, in order to figure this shit out. And this is continuing to happen now. Goldman Sachs is known to be a bad actor. They left us holding bags with toxic securities that they funneled in to the market after they realized that the mortgage-backed securities that they had created were all dog shit. And they had been collecting all of this money with mortgages that were going to go into default at any day, and then they just threw that out into the market to get rid of it, and then they turned around and shorted it. That's the really fucked up part. Like, Goldman Sachs is a clear example of the worst acting prime broker on Wall Street, and they have the money in their portfolios to prove it, because that's survival of the evilest on that fucking street. So the DTCC and its subsidiary, the NSCC, should introduce clear policies to establish transparency around the circumstances under which the DTCC may waive an excess capital premium charge. Such decisions should be subject to review by the SEC. Yes, there are conflicts of interest here. If these clearing firms are waiving capital requirements for all of these other broker dealers, there's a reason why. Somebody's getting paid off. I guarantee that if the SEC was acting in good faith for the sake of the retail investor, that if they started to investigate the reasoning why these capital premium charges were waived, they would find bad actors within the clearing firms that were taking payoffs from the firms that were guilty of doing this. The risk that they're introducing into this market is stupidly dangerous, and it's probably created the derivatives time bomb issue that I've been discussing. It's probably worse than we even think. All right, so this is one that's a little bit more concerning to me. The DTCC and its subsidiary, the NSCC, the SEC, and Congress should introduce an emergency backstop funding facility for NSCC member firms that provide emergency liquidity to the NSCC. No, I absolutely do not think that this needs to be put in place. If they add additional liquidity to backstop any of these bad acting firms, then they will lean on it like a crutch. If they allow them to take this position, and if Congress themselves, oh my God, I swear, if the government puts a fucking slush fund together for these assholes to say, oh, we're liquid, it's going to be abused. This is the last thing that they should do. They should not be trusting these firms to act in the interest of their other members and for retail investors especially. They're in it for themselves. And if they can get away with not having to post additional collateral during excess liquidity emergencies and exigent circumstances, then they're just going to use that. They will only rely on that. It's the last thing that we should do. They do not need any more money. They have plenty of fucking liquidity. They need to act more responsibly, and they need to police themselves better. And better yet, the SEC needs to actually themselves be overseen by another independent firm or some investigative bureau. I'd like the FBI to get involved personally. They're at least a little bit more independent. But whatever. This is a bad idea. They should absolutely not take government funding and set it aside for when the NSEC fucks up again. They will. And if they have taxpayer dollars to back it up with, guess what? We're going to be the ones that pay. All right, so this goes on for quite a while longer. This report is thick and dense with information, but there's only a few more spots that I think are actually worth noting out here. This is something that we're going to be picking apart for a long time, I'm sure. But this video is going to be over an hour and a half at this point, and I don't want to drag you guys on with me for that much longer. This report comprises one part of the committee's response to the Memestock market event, which includes hearings and consideration of legislation addressing issues such as gamification, short sale disclosure, payment for order flow, and other related issues. The committee staff spoke to agree. Excuse me. The committee staff prepared this report to highlight the structural issues that the Memestock market event exposed. Experts that the committee staff spoke to agreed that while aspects of the Memestock market event were idiosyncratic, they expect market volatility driven by retail investors empowered by technology to be a recurrent trend. This is a very important statement. Retail is here to stay. We're not leaving, and they know it. They know that we exist here now. This is the space that we have taken control of, and they need to consider us. We're now a threat. We are an actual threat to the system. But it's not because we did anything wrong. It's because we figured out everything that was going wrong with our system. Now, for the first time, we have forced Congress to look at it. And I am very glad to see that, at least in many parts of this report, they have agreed that there are problems that need to be addressed. There's a lot going on in this report that has revealed the inefficiencies and the structural risk in our markets, but moreover, it's really showed how there are a great deal of conflicts of interest, and that has to have been seen by these investigators. We need to hold the pressure on, though. And this is what I want to say in closing. There is some serious pressure being applied to Congress right now that needs to be ramped up. The decision to take away the buy button that was made by Robinhood was not exclusive to Robinhood. Robinhood was the smallest with the least liquidity. They were the guilty party because there were more retail participants using their platform than any other platform. And that's the only reason why they're taking the fall for this, is because they were the easiest one to fry. But I can promise you that TD Ameritrade and Charles Schwab were just as culpable. Both of those firms also shut off their buy button. And the worst part is that they did so at their own discretion. So I apologize. It was Interactive Brokers and Apex, not Charles Schwab and TD Ameritrade. I have I have my suspicions about those firms by themselves, but IBKR and E-Trade were two of the other firms that were the ones that were most restrictive throughout, specific to AMC and GameStop. Interactive Brokers actually restricted more stocks than just those 13 that Robinhood restricted. What was so bad about Robinhood's restrictions was that they had placed position limits on more than 50 stocks the day after that the squeeze hit its peak, which is it's actually hilarious. But this is why Robinhood is the one taking the fall and not the other brokerages, because they were the easiest one to fry. Like I said, we still feel like that's the strongest case against them, is that Robinhood made the decision to just maintain these restrictions for as long as they possibly could, and that really introduced everybody who had jumped into trading on their platform for the express purpose of trading these stocks. That's why we all got so pissed off. So it's not surprising. But it's interesting that Interactive Brokers and Apex, which Apex was clearing for Webull, they also restricted these stocks. So they're not exclusive, okay? And many of them, they experienced, they made this decision not because they were necessarily at a risk of a liquidity crunch. They did so because they saw the direction that it was going, and they didn't want to introduce the risk to their books. Like, they didn't have to shut off the buy button. Robinhood did in a situation where they didn't provide the capital requirements and they had no way to do so. But Apex and IBKR, they didn't have to. Interactive Brokers, I know for a fact, had plenty of liquidity. They're one of the largest international trading firms and brokerages. They had plenty of capital to be able to maintain trading throughout the day. I just don't think that they wanted to deal with the risk. So they shut it off to be safe. And that's a problem. So there's other firms that we need to be looking into. I'm especially curious about Charles Schwab and TD Ameritrade, because it was their data that was burned in the Bartlett fire in this past January. So and that involves other things like a federal inquiry and investigation that was going as a part of a RICO case. That that really that really still continues to be a point of contention with me, that I'm still continuing to look into and finding what the connections are as to why they would be incentivized to set their own warehouse on fire. I'm sure that the reason would never come to light, and I know that this is like deep conspiracy theory, tinfoil hat shit, but it just doesn't sit right with me that in the middle of a federal investigation, a a cold storage facility for storing paper records for Charles Schwab and TD Ameritrade, among other brokerage firms and Citadel, went up in smoke during that investigation. It still bugs me. I'm never going to forget about that. But anyway, I believe that this is as much as I can take the time to share with you all. This document is so dense. There's so much in here. They have evidence dating back, like they even have Elon's tweets in here. They have so much evidence marked up in here that we can go through, and I'm sure that we'll be picking this apart for months. So I'm not going to rush it with you guys. We can take the time to examine this far into the future. But those were the highlights and my initial thoughts after spending the last 5 hours digging through this entire document. All that being said, I want to thank everybody for taking the time to sit with me through this as we went through this document. I know that it was a lot to go through, but there was some key things that came out of this investigation and the committee's findings. And I do think that change is actually on the way, but there are some things that we need to be very concerned about that are written in this document. We know what the structural issues are. We know the firms that turned off the buy button are at fault for their decision for many different reasons, but some of them did it because of liquidity issues. Others did it because they didn't want to introduce the risk themselves, so they took a voluntary position even if they could sustain trading. And those are the firms that I'm more pissed off at, more so than Robinhood at least. All the same, the findings of this were summarized as Robinhood sucks, which I'm not surprised they're throwing them under the bus. 2, the NSCC and the DTCC are not watching their brokers or their member firms. The SEC and the FINRA regulators are totally ineffective at doing their jobs, and they're not watching anybody effectively. And also, the market structure, liquidity, and risk management practices that are instituted by all of these entities is totally ill-equipped to deal with us. And you know what? I like that. I think that that's a fucking phenomenal thing. Just because we're here, just because we decided to buy and hold, we have thrown a giant wrench in the cogs of the entire market's mechanics. That really says something about our power. So I know that people will be debating this document for many months going forward, but I'm at least encouraged with the knowledge that I'm creating problems for Wall Street, and so is everybody else. That makes me feel good. So, you know what? I'll take this one as a win. So, thank you, Representative Waters and Al Green. At least I appreciate the effort that your investigative team went through to turn this up for us. We look forward to creating more work for you later on when we start demanding the regulators actually take some fucking action. We'll be looking to you to enforce our demands. So, to all of you, thank you so much for sitting through this with me and actually digging into this document with me. I really appreciate that you chose me to help and explain some of this to you and highlight all of the main findings. I know it was a lot to go through. I know it's dry content, but I guess you wouldn't be here if it didn't matter to you. So, for that, I really appreciate it. That's it for the video. I'm looking forward to digging into this a little bit further in the following months. But until then, thank you guys so much for watching. Y'all have a hell of a weekend. I'll see you at the bell.